Hey, welcome, ladies and gentlemen. Thank you for joining us today on Texas Agent Strategy. I'm Kevin Gillespie, president of Lakeway Lending, and we are the presenter and sponsor of Texas Agent Strategy, trying to help agents up their game without breaking a sweat. And so if you're looking for ways to up your game, you came to the right place, and especially today, because we got a special guest today. I've really been wanting to get this guy on, and I'm a little longer than most. I got to tell you about this guy. Okay, because he's going to show you how to do loans for people with no payments. That's right. Absolutely, that's it. But here's the deal. Ray Daniel. Ray is a mentor of mine. I've known Ray over 35 years now, but it's kind of hard to believe it's been that long, Ray. But when I was a young mortgage banker, I'd go sit in his office because the guy is amazing. He now has over 40 years experience. He is a Texas real estate attorney and mortgage banker and is the next president of the Texas Mortgage Banker. On top of that, more importantly, he is an awesome guy. He's 1,000% honest. He and his wife, Jerry, have been friends of Janice and mine for, well, like I said, 35 years, and they have helped me more than I will ever be able to repay. And I tell you what, he's also a great dad and a grandfather as well, and he's about helping people the right way. So let's learn how we can do loans with no payments for the folks. Ray, thanks for taking time, man, to talk.
Thanks, Kevin. I appreciate it. Yeah, Kevin and I go back to 1983, which is a lifetime ago. We worked with North American Mortgage back in those days, and today I'm with Fairway Independent Mortgage, a reverse mortgage division, which I'm concentrating on helping seniors to secure their retirement by eliminating the mortgage payment on their home so they don't have that cash flow going out every day or every month for the mortgage payment. This program, the HECM Mortgage for Purchase program, was originated in 2009 to allow seniors to be able to buy a home with approximately 50% down on their house and then never have a mortgage payment for the rest of their life if that's what they decide they want to do. It's actually an optional payment mortgage, so you can make payments if you want to, if it makes financial sense from a tax standpoint, from an IRA standpoint. There are a lot of strategies that can be used in the reverse mortgage for purchase.
But Ray, can I interrupt? Guys, you really got to catch this concept, because if you're like me, I was thinking, well, reverse are for elderly folks that have a house and they want to get some cash out. The real strategy here is if they want to move, be near the grandchildren, they can literally buy a new house and have no payments. Is that correct? That's
correct. Yeah, there's two programs. The refinance program or cash out program that you're talking about was originated back in 1988. So it's been around for, 30 plus years. But and that's for seniors who have their houses paid off and would like additional cash flow to be able to, go into retirement. Once you get rid of that primary job and have that primary income coming in every month, when that goes away and you're relegated to your Social Security payment and other investments using the old 4% rule of taking money out of your IRAs and 401ks. Unfortunately, because interest rates have declined so much in the last 10 years, we're down to a Fed funds rate of 0 to 0.25, which means, banks can borrow money from the Fed for 0.25%. That's the baseline. So guess what you're getting on interest on your savings accounts? Not much of anything. So plus we're at an all-time low for reverse mortgages. What that means is that you can borrow more money against your home, or you'll have less money to put down if you buy a new home with the reverse mortgage. So The key in Texas is that both husband and wife have to be 62 years of age or older. They must live in the home as their primary residence, which is defined as living there for 6 months and 1 day a year. So they could have a retirement, they could have a second home in Florida or in Galveston or anywhere else, but as long as this is their primary residence, they can have a reverse mortgage on that product, on that home.
Now,
So,
Ray, I know for those of you watching on YouTube, we've got these slides here, and for those of you listening, we've got a lot more detail, but can you give 1 or 2 examples of people that you've helped and what a difference it's made to kind of show how it works?
Yeah, I just had a couple, the 70-plus-year-old couple who lived here in my neighborhood in the hills of Lakeway, and they had a house that was way too big for them because all their kids had obviously gone off to college, gotten married, and have grandkids. And their house was valued at about $950,000. But they wanted to downsize and find a home that was a lot easier to work with in retirement, i.e. they had a 2-story house with a lot of the rooms upstairs. They wanted to get a 1-story house with very low maintenance. So basically I said, if you list your home with a realtor and sell it, you're going to net, he owed about $150,000. So you're going to net somewhere around, $760,000 from the sale of that house. And he said, well, my wife and I want to limit the purchase of a new home to about $600,000. So he could pay all cash, but that would limit his liquidity in retirement, which you don't want to do if you're a senior. So basically I said, okay, well, you go find a house, which he did. He sold his house, closed on it, put about $750,000 in his savings account. He and his wife went out, found a new home that was a lot newer than the one they were in. Obviously it was more energy efficient. It was 1-story. It had very little maintenance. It was actually in Flint Rock Falls, right next to the country club, because he's a big time golfer. So anyhow, he put a contract on that house for $600,000. I lent him $293,000, and he came up with $307,000 and was able to purchase that new home. And then once he closed, he never has a payment for the rest of his life on the $293,000 mortgage that we put on the house. It's just like a forward mortgage. It's a mortgage,
And he's still got to keep $300,000 of liquidity to help them with their lifestyle.
Yeah, that money is going to generate more income for him when he puts it with his financial planner, who's going to come up with a strategy to, probably get somewhere in the 6 to 8% range on that investment going into the future. So it can throw off cash flow, and he doesn't have a house payment. So now he can play more golf. His wife can shop more. They can go on trips. They can go on vacations. They can enjoy their nest egg with their grandchildren while they're still active. So all reverse mortgages, you keep the title to your home. The lender never owns your house. That's one of the biggest myths out there. It's a mortgage, just like if you have a regular mortgage. And
that's for those of you in your database. If you've got some elderly folks in there and think, well, I won't be, boy, this is a great strategy, or some of your friends, their parents, another great, you got to get, not a lot of people know about this. And no, even though Ray's a competitor, he's my friend, but more importantly, you really need to know about this program. So Ray, what are some more of the details that they should know about this program?
Okay. Yeah. The biggest plus of the program is that it's very easy to qualify. When you get a Fannie Mae or a Freddie Mac forward mortgage, conventional loan, you put your 20, 30, 40% down, and then you still have to qualify on a 43% debt to income ratio.
Am I on the right slide, by the way?
What's that?
Am I on the right slide here?
Yeah, you're okay. Yeah, the only thing you're responsible for once you get this mortgage in place is that you're required to pay your taxes, your real estate taxes, your insurance, and any homeowners association fees. So that would be required whether you have a forward mortgage or you have no mortgage. If you go into default on your tax payments, the taxing authorities can actually foreclose on your house and put you on the street. So that's the basic requirement for the qualification. So we only qualified this loan because there are no payments. We qualified on your ability to pay the taxes, insurance, and HOAs every year. So that's a very low bar. Somebody on $2,500 in Social Security, based on the cash that they're going to have that they don't put down, we use those assets as dissipating assets to actually help qualify them. So somebody making $2,500 with $400,000 in the bank can qualify for, a $400,000 reverse mortgage. So that's not something you could do on the forward side. So that's a big thing. Go to the next slide. This mortgage stays in place for the rest of your life. So you have a contract with the federal government that says that you will not have a payment, not a required payment, for the rest of your life for both the husband and the wife. So it's a good strategy if one of the seniors is, maybe at some point going to have to go into another facility. In the example I used, he still had the $300,000 that he didn't put down to pay all cash. So, if for some reason one of them has to go leave the home, that loan still stays in place until both the husband and the wife leave the home, or they can sell it at any time. They get a monthly statement from the mortgage servicer that says each month you owe X number of dollars. So, they list the property. They give the statement to the realtor. That's the amount of money that you're going to pay off. They sell the house and they still have $300,000 in equity. Then that money goes to them when the house is sold. The big thing about an FHA mortgage is that the mortgage insurance you pay on this FHA loan is actually insuring you and the lender, because there's no recourse and there's no liability on the reverse mortgage loan. So regardless of what happens over the next 30 years, it has nothing to do with the value of your property in terms of having the loan be called due because you owe more than the house is worth. That's not the case. And if in the end you live for 50 years and you owe more than the house is worth at the time both of the husband and wife pass away, then there's no liability to the kids, there's no liability to the estate. FHA steps back in and pays the differential between the current market value at that time and whatever the loan balance happens to be if it exceeds the value of the property. Okay. So, in essence, realtors should look at this is that every house they have, every listing they have can be sold to a senior couple over 62 for 50% of the value of the house. So your $500,000 listings could be sold for $250,000 cash with no payments for the rest of the couple's life. If you're selling an $800,000 mortgage, the buyers put down $400,000 and they have no payment on the other $400,000 for the rest of their life. So, if you can buy property at 50% as a senior when you only have Social Security income, that's a pretty neat deal, because newer homes obviously don't have the maintenance of older homes. This could help realtors to list property, because the biggest question that a senior has when when they decide they want to sell their house is, where am I going to go and can I afford where I'm going? So in this case, if they were selling a home in Lakeway and the house was worth $500,000 and they owed $250, they'd only get $250 out of the sale. And if they only had to pay cash, they'd have to find another house for $250. But with a reverse mortgage, it doubles their buying power. So when they net $250, they can still go out and look for a newer, more energy efficient, maybe in a 55 plus community, and put that $250,000 down and buy a $500,000 house, and not but for the rest of their life.
Okay. Type of properties that?
It's for 1 to 4 unit properties, just like a regular FHA loan. You can buy a duplex. The only requirement is you live in one side of the duplex, and we will give you credit for the income on the other side when you lease it out. Condos have to be in an FHA approved condo project. So this is a place where we have to go look up the records at HUD as to whether the condo project they're looking at is FHA approved. And there are quite a few out there, but not all condos are FHA approved. So that can be a problem. Townhomes, anything that's single family, fee simple can be used can be used for the reverse mortgage. So the only thing in Texas, you have both husband and wife have to be 62, and the property cannot be in a living trust at the time the mortgage is put on. So I have clients that have their house in a trust, and all we do is have it deeded by the trustee back to the seniors prior to closing, and they close on the mortgage in their own name so that they hold title to the property. And then at a later date, they can put it back in the living trust if they want to do that.
Okay, good. Seller concessions?
Yeah, seller concessions, basically the seller can pay all normal and customary closing costs in Texas. So that would include, they can pay the title policy, they can pay for preparation of the deed, they can pay for recording fees on all the documents for the seller. You just can't write a contract and say, okay, we're going to put in a $10,000 allowance for carpet and repainting. That wouldn't be allowed. So, and the contract is an FHA loan, so there's a category on the Texas contract that says it's financed with FHA financing. And when you do that, there's also an FHA amendatory clause, which says that if the house doesn't appraise for the sales price, the buyer can get out of the contract and get their earnest money back if they decide they don't want to go through with the transaction. They can still go through with the transaction, just that extra differential would have to be paid in cash by the borrower.
Now, Ray, inventory in this marketplace is pretty low. Let's talk about new construction, because sometimes that's what people would like they can get a brand new home, right?
Right, exactly. A lot of the 55 plus communities, I think in the Austin area, there are roughly 10 55 plus communities where they are age restricted. In other words, you can't buy a house in those communities unless one of the occupants is 55 years of age or older. To do a reverse, both would have to be 62. But anyhow, and so in those situations, we basically take an application just like you would on a conventional loan, and we pre-qualify them if it's to be built. And then we come back at the time the house is complete, and we get the final appraisal on the house, and we complete the transaction. Real estate HECM for purchase loans. HECM means home equity conversion mortgage. That's what an FHA HECM is. So basically, in those situations, once you get to the end, the buyer would have had put up, earnest money. They might have put up some extra cash for extras or upgrades in the house. All those things obviously would be credited at closing against the 50% required down payment.
And is it fair to say, because it's an FHA program, it's insured by FHA and it's government sponsored, so it's a very safe, secure program if anybody has any fears,
Yeah. Basically, this is a contract written at the time you close that guarantees all these protections that are built into this loan, i.e. no liability, non-recourse. So, you don't have to pay that. You won't ever have to pay the loan until both the husband and wife leave the property, either voluntarily or involuntarily. So, seniors tend to, maybe go into a rehabilitation clinic for 4 or 5 months if they break a hip or break a leg or whatever. That does not cause the loan to be called due. It's when both of them have left the property and they're no longer going to return to that property as their primary residence.
Okay. And so now the other thing we've done, anything else on this, benefits of buying we want to talk about here?
Yeah. A lot of people think, oh, well, it's an FHA loan, it's going to be complicated. Well, in today's environment, because we are a separate division of Fairway, we have all of our own loan processors, underwriters, and closers. So we can close a purchase in as few as 17 days.
That's great.
So that's pretty quick. It really, if you're 62 and older, the government is basically saying to the senior community, hey, if you want to make this program available to you, if you want to take advantage of it, you can save yourself a whole lot of money leaving your checking account every month that you're pouring into the equity in your home. Equity in your home is really illiquid cash. So when you pour it in there, your loan balance goes down. That's the biggest differential between a forward mortgage and a reverse mortgage. In a forward mortgage, you make a monthly payment. That covers the interest on the loan and it pays down a small percentage of the principal. In a reverse mortgage, we start with a balance of $100,000. If it's a 3.5% interest, at the end of 1 year, we add $3,500 to the principal, and so they would owe $103,500 as their loan balance going into the second year. So that interest does accrue. It does not have to be paid until the owners of the property decide to sell it or if both pass away.
And the home is appreciating typically most.
Yes. Yeah, you get the same leverage as you would with a forward mortgage. Your home's appreciating. FHA assumes in this program that over a 30-year period that property is going to appreciate 4% annually on average. So today we know that the market we have right now in Austin, Texas, about a 1.6 months worth of inventory. The average inventory for, for a neutral market is 6 months inventory. So if you're in 1.6% inventory, that means that there aren't enough listings on the market to satisfy the demand for housing. So if you are in a seller's market where you're getting multiple contracts, you're getting people overbidding the initial list price of the home if it's in a high demand area. So right now is an excellent time because the last reverse mortgage I quoted, the interest rate on the loan was going to be 3.13% on an mortgage, which is just as good as a forward conventional mortgage.
Yep.
Yeah.
This slide here.
Yeah, this basically tries to break up where all your money goes throughout your life. Ages 18 to 61 are your earning years. So you're getting regular wages. That's all the money that comes into you. And you're taking a portion of that and dumping it into bucket 2, which is your 401ks, your IRAs, all of your lump sum nest egg life insurance premiums, cash value life insurance premiums. And the third bucket is where you're putting your regular earnings into a mortgage payment. And that mortgage payment is every time you make a payment, the principal goes down very little, but it does go down. So, and the market's appreciating. So you're creating equity in the real estate equity bucket number 3. That's the illiquid bucket. Number 1 bucket from age 18 to 61 is typically, that's your checking account. That's where your earnings go every 2 weeks to pay bills, pay electricity, pay all the other things you have to pay. And then you try to save money for retirement or for emergency or whatever, and that's where you're putting in bucket 2. So the government realizes that after you retire at 65 and you no longer have that bucket 1 income coming in, now you have to dig into bucket 2 to maintain your standard of living.
Now, if they're still working after 65, though, that doesn't...
No, you can work forever. There's no income requirement that, hey, you make too much money, you don't qualify for this project.
Okay, good. Well, the other thing that's really important about this that Ray's talking about, guys, is the fact is for the average American, 83% of their retirement wealth is home equity. And to Ray's point, it's illiquid. So you've got to find a way to get at that to make use of it. And so this, again, is a perfect tool to do that. Yeah.
Going back to the first program for the refinance, if your home's worth $600,000 and you owe 150, a lot of people think you have to own it free and clear to get a reverse mortgage and to create cash. That's not true. In that scenario, the house is worth $600,000. They owe 150. I come in, I pay off the $150,000 loan that requires a payment, and I give them on top of that another $150,000 either in cash or a line of credit that they can draw on and take going into the future. So that line of credit becomes, in essence, like a HELOC, but it's not callable. It's a guaranteed lifetime contract with the federal government. And the unused line of credit actually increases every year by the interest rate plus the MIP. So today, those line of credits, if they start at $150,000, after the first year, that $150,000 line of credit adds to it 3.5%. So that's about close to $5,000 that would be added to it. So your line of credit at the end of 12 months would actually be $155,000 that you can draw from.
Yeah. So guys, in fact, we're just touching on this and I'm looking at time. And so, and Ray's got a lot of great slides and examples if you're listening to this. So Ray, the best way to get in touch with you?
Yeah, it's just call me on my cell phone. I talk to seniors every day. Call me at 512-695-1017, or you can email me at ray.daniel@fairwaymc.com. That's
great. Good deal. Well, Ray, again, I know you're busy, but your heart is like mine. We like to help people and know that that's where we get our joy and fulfillment in life, and it helps us pay our bills. But you do a great job helping the seniors there, and I really appreciate it. And agents, if you got anything out of this, you can sell more homes and truly help more people with Ray's program. So any closing thoughts here, Ray?
Yeah, my biggest closing thought would be that I can empathize with seniors because I am one. I've been over 62 now for 10 years. So I know the value of cash flow in retirement. Nobody really understands until they don't have all that money coming in every month that life takes so much money out of your checking account every month for utilities, for groceries, for, the COVID-19. A lot of us got our portfolios dented by 20 to 30% if we were invested in the wrong assets. So, all those things make life stressful. The idea of a reverse mortgage is to help you live longer by reducing the financial stress in your life. So if you can reduce financial stress, you're going to be a healthier senior. And, now, and when I was born, I think the life expectancy was probably about 68. But now, we're talking, I think the tables show 83, 84, 81 for men, 84 for women. But in reality, if you make it to 65, you've got a 1 in 4 chance of making it to 100. So that's a 35-year retirement.
Yeah, exactly. So great. Again, Ray, I love you like a brother.
I love you too, Kevin.
You've been truly a good friend. And so thank you for coming on and helping the agents here today. Agents, for those, whether you're watching or listening, I'm Kevin Gillespie at Lakeway Lending, and we appreciate you tuning in because we wouldn't be here if it wasn't for you. You help us feed our family, and you help build communities. And that's what you do is very honorable, and we respect that and appreciate it. And if we can help any of your folks buying or selling or needing to refinance, we'd love to. Just reach out to lakewaylending.com. With that, I guess we'll sign off. And
thank you, Kevin, for having me. I appreciate it. You've been a good friend for 37 years. So hopefully we can do it for maybe 10 or 20 more years.
I hope so, too. I'm betting on it. So, guys, with that, we're going to sign off. Wish you nothing but the best. Thanks.
See you later.